trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good morning, Market Rebels, and Happy New Year, Stu. I think this is our first one of the year, isn't it?
Unless you were doing one without me, yeah.
I know this. I think this is our first one, but it's great to be back, and we have really a few special ones. I guess they're all special, but I mean extra special because we're going to give you kind of a sneak preview into what we're going to be doing in Miami. But always good stuff. So for today, Stu, good question. This came up in one of our Q&A sessions the other day, and one of the themes that we get a lot in our Q&A, or I think our teaching themes, is about misperceptions that people have about options, and they're super easy to fall into because we see it with our eyes. We say, well, that's got to be the way that it works, and they're not. They're missing the behind the scenes point. So for today, we're going to answer what seems to be an easy question. Why are out of the money verticals so cheap? Now, if you ask most people, what do we get for responses?
You're laying off, you're reducing your cost basis.
Reducing your costs, I'm getting a good risk reward ratio. I'm
Yeah,
getting
you can
lots of
spend one to make four. Hey, I'm in because that's super cheap. Yeah,
I'm controlling shares of stock for only
nonsense.
$1 now. They're
Yeah.
always focused on the price. One of the things we're going to show in Miami is that's the first illusion, is that options don't live in price space. They live in strike space. We'll explain what that means. But prices are an output from a pricing model. They're not an input. And what that means is if you take a Black-Scholes model, stock price, exercise price, you all know the 5 different factors, or 6 with dividends, that we get an output of here's the theoretical option price.
Yeah.
Well, people work that backwards and say, let me find the option price. And no, that's an output. And we have to understand that the options are strike based. They don't know anything about prices.
For those that kind of understand that process a little bit, or don't understand and wish to understand it, that model thing that Bill was talking about, which there are a lot of them actually. There's probably like hundreds of them. Some of the more
Probably they
famous
all
ones.
minor tweaks to them. Yeah.
Minor tweaks, yeah, tails, early exercise, things like that. But they're all kind of doing the same thing. Cox
They all
Rubin,
come up with very close prices.
Black-Scholes.
Yeah.
And they are, like Bill said, they are really just a model of inputs. You can put in any of the inputs, any of them, leave one out, and the one that you left out will come out of the model. If they're all interchangeable. So in part, when Bill says, options don't live in price space, the price is just the output of the model. That's all it is.
That's right.
It's people, there's a mystique. It's funny. Like there's this mystique about the world of options and the whole derivative thing and market makers, and this mystique is really unfounded because it's not that difficult to understand. It's just that we've been or people have been taught,
That's
or
right.
they've learned, or they've picked up, or they've somehow figured out that they think that what they see is what they see, but it's not really so.
Exactly. So for Miami, if anybody can make it, we're going to be there on January 29th and 30th. And there is a phone number for all of our market rebels out there. You can call your sales rep, but we would love to have you. It's special for us because normally we get one or a couple of 45-minute presentations. We get a rotation of a lot of people. Stu and I are going to be by ourselves, separate room, separate stage for a day and a half, showing you from an academic perspective, retail perspective, and a professional market maker's perspective, the proper way to see and understand options. And it will be extremely revealing. We promise you that. I would say that 99% of the stuff you will have never seen before or have heard of. And we want to give you a little sample of that. And so here's our Chalk Talk question. Should be pretty obvious. Stock is 100. We're looking at let's say the 105, 110. So both strikes are out of the money. This is a call spread. Should have put that in, but this is a call spread and it's trading for $1. All right, so the stock's at 100. We're buying the 105 call. We're selling the 110. So it's only trading for $1.
Out of the money call spread, typical.
We know that it can be worth how much? 5, the difference in strikes, and that's because we have the right to pay 105. If we were to exercise, we'd have the obligation to sell at 110.
Subtle little statement here. People often get this confused. It's not that you can make 5; it's that the full value can be 5. But
The
don't ever
payoff,
forget
that's
that,
exactly
right?
right. The payoff.
Right. The payoff can be 5. You're going to pay
Profit would be
something
4.
for the payoff, whatever you're paying, and that's what comes your profit. That's what comes out to be your profit. So
Exactly. So let's take a look now. Again, this is going to be a little kind of a little sound bite, so to speak, from our presentation, and to give people a different perspective, just to show how kind of revealing this is going to be. So one of the things you have to understand is that options do not live in price space. It's not about prices. It's about information. And so one of the things we're going to show in lots of different ways is that options are an information game or information over time. That's the proper way to see them and understand them. So for example, here's 50 cups. And let's say that, Stu, they're all empty except one has a $50 bill under it somewhere. And you get to pay a fee to come up and turn over a cup. What's the fair value of that bet right now?
well, there's 50 spaces, and I'm going to win how much? $1?
50.
50? Oh, $50. So I got to pay $1 for it.
You'd have to pay $1. You have a 1 in 50 chance to win $50. So, right, so
Right.
just take 50 over 50, which is $1. So theoretically, if he paid $1 for this over and over and over, he would probably have to pay $50, and then every once out of every 50 would win 50. He would just break even. That's what we call the
It
fair
would be a
value.
break even. That's right. Could I?
But,
Hey,
but
Bill. A little side note. Could I pay less and have a better chance of winning
would not have a better chance of winning. It would improve your expected value.
if I paid more? Would it lower my chances of winning?
Would not lower your chances. It would worsen your expected value.
So see what's going on here, everyone. Price is, this
Yep.
model of
Right.
sorts is creating
That's right.
this price. The values are changing. The expected values are changing via the circumstances that are present.
Right. So let's say that Stu comes up and he turns over a cup, and as expected, right, that's the probability that there's nothing under there. Now, most people who are options traders would say, well, that really stink. We ended up with nothing. It was a big dud. Let me move on to something else.
I hate
But
when that
hold on a
happens.
second. What's the game worth now?
Well, what do we think, everyone? Do we think it's worth more, or do we think it's worth less? See, now there's less
Still
chances
right. We
to
still have the
be
maximum
wrong,
payoff. Yep.
right? There's less chances to be wrong. The payoff number is still there, but there's less chances to be wrong. So that means it's worth a little more.
Worth a little more. So we would take 50 divided by 49,
49.
which is going to come up to, let's say, $1.01. Now, where did that 1 cent come from?
Oh, it went to like fade to heaven, I think.
That's delta. Okay, that is delta. That is the change in the value is not coming from, oh, it's because the stock went up. Everybody thinks it's because the stock went up. It's because the probabilities went up. And so what happens is, now watch as we're going through, let's say another cup is overturned, and we say, Still looks like it's like we're not learning anything, but we are. Learning where it's not
Where it's not. Yeah, I
is,
often say that. Look for what you can't see. That's
yeah,
right.
and we're not saying it's better than finding the money, but it's also not worthless either. And so as time goes by, this would be our kind of our model. Time is going by. Even if the stock is staying nowhere, we are learning where it's not going. And so let's say that we get down to this. Can you feel the tension if we still haven't found it? What do
I
y'all
feel like
think?
I'm on that game show and I won 500 grand and the guy's saying to me, "Do you want to bet another 500
Yeah,
grand?"
we're going now. Why do you feel like it's getting exciting here? This is gamma. We know that one more cup is now revealing lots of information.
See what happened? That delta kept going up and it was going up. And the factor that was going up was that's what Bill just said. That's your second derivative. That's your gamma.
Yep. And so now what we're seeing is that when we turned over the first cup, didn't have much value. Now it does. If we haven't found the money, there's now a 25% chance we're going to find it. And that's why your options can explode near expiration.
And why could this be super important, everyone? Because the option that you had is now not the option that you have.
Absolutely. Everybody thinks it is. Oh, I've got the
It's
same
it's
option with less time. I need to bail it and go on to something
it's
else.
a brand new look and feel and everything else and exposure rate and everything is different about it. So it is possible that perhaps you want to or could be doing something with that position to make an adjustment to that position since it doesn't really look like what it is that you started out with. And maybe even it got to where your goal was, and maybe
Right.
it's time to exit that position. But the point is, you have to go through that process
It's a
of
learning process.
asking yourself these questions and recognizing that what you had is not what you have, and is it time to do something about it? Instead of saying, "Well, is it where should I sell this option?" Right? I don't know.
Exactly.
Sell it at the
You're not
top, sell
playing
it at the
the
bottom. What I don't know. Pick the top. If you have a call, pick the top of where the stock is and go sell it. Right? That's your answer. Well, that's ridiculous, right?
right.
So this is part of the risk management process that we're talking about.
Yeah. So now we can see where gamma is coming from. It's not because it's unfair and suddenly option prices explode or implode, but what we're seeing is that we have fewer states to exist in, or in this case, fewer cups. And here's another mistake that people make. Traders will get to this point and they'll say, well, you know what, Stu, nothing's happened with this. Let me roll out in time or let me go to a different ticker. What have you done? You've just gone to a low information state. You've gone to where you now know nothing again. Turning over a cup, see, it feels safer because you have more time. And you go, okay, I only lost $1 or lost a little bit because you've reset the clock. But people don't realize you've also reset the information, the ability to learn. And if you understand that this is the space, we're going to show it's actually a grid called information time, and that will greatly change the way that you see strategies. Now, a lot of times people think having more time is safer, and that is not true. It's safer what we call locally. Yeah, today the next cup isn't going to cost you much one way or another. That would be the equivalent of adding a cup, maybe the stock ticked away from us a little bit, or removing a cup. It's not going to change the value of that 2-year leaps option by a lot. Probably not going to affect it at all. And that's why people think they're safer. But the reason they don't respond as much is for this reason. There's not a lot of information being revealed 2 years out and saying that one day's gone by and the stock ticked up 50 cents. Who cares? That didn't tell you anything. So another thing to
You mean my
understand is
delta's
that
not going to change if my stock picked up $1 if I have a 2-year out at the money?
probably not going to budge. Probably.
Right.
And this is why. See, this is exactly why is that if you understand it from it's about revealing information, did it really teach you anything? No. And that doesn't make it bad. It means it's a different strategy. We don't go out to leap because they're safer. It's because we're on a different strategy. Now, here's another thing where people think, well, more time automatically means safety. And that is not true. And one of my favorite ways to show that is right here. If more time was safer, Vegas would make roulette wheels spin longer. Right? Why don't they do that? Why don't they make them spin for 2 hours if that were safer for them?
Seemed to be a little boring.
Well, see, and now we're on to kind of a side topic here. They want what? Do they want time or do the gamblers want resolution? They want information. They want that information to resolve quickly. They're basically playing very short-term options. Now, I know we've talked about this before. If you really wanted to turn over the information the quickest, if you wanted to make it the most optimally efficient game, not fair, but efficient, you should put your money on the table and they should push a button that reveals the answer. Why even wait for a minute or so for the wheel to spin?
Because that wouldn't be any fun. There's no anticipation.
Exactly. Now you're starting to see it's more of there's a psychology behind it about waiting for information to reveal itself. That's what they're selling. So that's a part of the trick. They got to make it resolve quickly. We don't want a wheel that spins for 15 minutes or an hour, but we also don't want to make it resolve instantly. Kind of interesting. So now let's take a look at another little model that we're going to do quite a bit in Miami. This is actually a variation of what's called a binomial model. Stu was talking about some of the other models out there. This is one of them. And we could actually start with an option and say that the stock could tick up $1 or down, or a penny or down a penny. And we could branch through and we're going to come up with the same answers that Black-Scholes will. But what I wanted to show here is more about this idea of revealing, or in this case, because we call it a tree, removing branches. That's the trick to understand as an options trader. So here's 5 coin flips. Okay, so we start off with a coin. We're looking at it vertically. Step 1, we could either get heads or tails. Step 2 is this vertical right here. We could end up with heads, heads. We could get heads, tails. We could get tails, heads, or we could get tails, tails. That's what 4 combinations after the second flip. Here's the third flip. And so once we get out here, these would be your option values at expiration. And this is, again, conceptually what's happening. So let's say that we're going to change the game here now where you get some kind of maybe $1 per head. There's only one way to get 5 heads right there. There's 4 heads, there's 3, there's 2, there's 1, and there's 0. Those are the only combinations that we could get for the number of heads. But there's lots of ways to get them. I have only one way to get 5 heads, and that's to walk up this branch right here. 1, 2, 3, 4, 5. That's the only way to get there. But notice if I wanted to get to 3 heads, there's 10 ways. Kind of hard to see, but think of it like walking through a forest here. I could go, there's 2 heads, come to tails, there's 3, and then back to tails. That's one path, those red arrows. But there's 10 of them. Kind of hard to see, but there's 10 different paths that lead right here. Now, by symmetry, there's also 10 that lead to 2. That seems kind of weird. Seems like it would be harder to get 3. But the trick to understand here is that if you imagine 5 coins in front of you, if 3 of them are heads, 2 of them are tails. So are you looking at 2 tails or are you looking at 3 heads? They're just 2 different ways of saying the same thing. So that's why they're symmetrical. And so there's 10 ways of getting that. So we can see that most of the probability is in here. So now think about this. Let's say that we flip our first flip here, Stu, and we get heads. What do we know? What's something that we just think about information, everyone? What did we learn? The bet didn't become more valuable because we flipped heads. It's because we learned something. What did we learn?
We learned what path we could be on.
But what's more important? There's lots of them we could be on. Again, that's like turning over 1 cup out of 50. Doesn't reveal much. But what we did learn is I now know for a fact I cannot be on this branch right here. Okay, I've removed the all tails branch. Now that's called a complete elimination of probability. But there's something else that's a little more subtle that's called compression of probability. And so this is where to get to 1 head, there's 5 ways. But 4 of them have been removed. Every one that starts with tails, right? I could have gone tails, heads, 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 heads. I could have gotten, tails, heads, and then come back
through tails down here, right? Tails, heads, tails, 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 looking at those top T's. That would still give us one head. But I could also do tails, tails, head, tails, tails. I could do every combination. Just think about moving that letter H through. All right, so I could have tails, heads, tails, tails, tails. I could have tails, tails, heads, tails, tails. You're just moving that H through the line. So I've removed 4 of those 5 ways. So that's been cut by 80%. And that's what we call a statistical compression. Whereas the first one was an elimination. So this is also what's called backloaded. The only way that we can now get one head is everything has to go perfect from here. We have to get 4 tails. So again, we used to have 5 ways. Now there's only 1.
So think about this, everyone.
It's a little
If you're in
harder
a
to see.
position and you say to yourself, in order for me to get to my end game,
Mm-hmm.
everything has to go perfect. In order for me to
Yep.
get to my end game, everything has to go perfect.
Yep.
Could you now be thinking, maybe that's not such a hot bet
Maybe
to
not such a
stay
hot
in it?
idea.
See, maybe you should be doing something about that low probability of getting to your end game
Right. It's
with
not about
the
saying, hey,
idea
I
that
got lots of time. That's irrelevant. That's just scale. It's a question of which paths do we know exist, or at least are possibilities, and more importantly, which ones have we learned are pruned.
that's a huge trap, everyone.
It's a
I hear it
massive
all the
trap.
time. Well, I have till what are we in here? January. I have till June, so
Well,
I'll
right.
just kind of hang out.
Or I've got till June of 27 or of 28. I've got
Yeah.
lots of, well, you've also got lots of cups to turn over.
You also have lots of time for things to go wrong as
You
well,
have
right?
lots
You
of,
always have to think of both of them.
right. Time is
Now
risk.
that doesn't negate this, which is a completely other topic of buying time in bulk is cheaper by the segment of time. That's another topic.
Well, it is,
But
but that's also, but why is it cheaper? For this very
for,
reason, right? The amount of information that you reveal from one day passing by is also very low. And so that's really the statistical way to see it, is that yes, but they're cheap for a reason. So another thing we're going to show is that the
the
variance
pieces.
scales the same way every single day. There is no such thing as options decaying faster. They resolve information in the same scale every step of the way. And so again, it's one of those things that shows where people step into traps.
What's that mean, Bill? That you can't change the rate of time that goes by every day?
Well, that's one way. Exactly. Time moves at the same
I'm
rate
trying
every
not
day.
to get older every day. Can you make that happen, please?
Right. So it's anyway, this is a really good model, and it's one of the things that's going to be a theme throughout the entire presentation. We're going to show lots of fascinating ways about strategies of what to do and what not to do. But keeping with this theme, think about it like football. Let's say the score is 0-0, and we've got a bet that maybe we can bet in real time. I can buy the bet during the game. I can sell the bet. Of course, the odds are going to change. The prices will change. But right now it's 7-0. And my question for the group out there, our audience, did the bet go up because the score is that there's a 7 on the board? See, that's what most options traders would tell you. Oh, the stock went from 100 to 103. That's why the option went up. That is not why the option went up at all. It went up because what do we know for sure now, Stu?
Well, we know that it's not. We know that there's less time involved. That's one
We
thing.
know there's less time, but what do we
Okay.
know about this team's potential? Think of all the possible futures before the game. What do we know now cannot be possible for this team?
We know that they don't have 0 anymore.
They cannot have 0 through 7. Correct. Of course, in football you can't have, but for all of the possibilities below 7, those are now eliminated. We're eliminating branches. And as time goes by, we might have said, you know what, it's unlikely, but 45 is a possibility. But as time goes by, what happens? Those branches are getting pruned too. If we're 7-0 in the half, 45 has probably been pruned.
See, it's like at that point, Maybe it's halfway into the second quarter. See, it's not the beginning of the game anymore,
That's right.
and
Time has
it's not
changed.
0-0 anymore.
Yep.
The game has changed.
The game has changed. Your option, as Stu said, your option is, it's not the same option that you held. People say, well, I have a leaps option. No, you don't. It's got 2 weeks left. And it's out of the money. It's not it's a 2-week option.
Yeah.
Yeah, but I bought it with a 7. It doesn't matter. That's not what it is now. In Philadelphia, it's what? 50
50
bucks.
bucks.
Here's what it is right now. And people don't want to play that game. Now, here's another way to show. I've had people that will argue with this. Well, I don't know. It is value. The value has gone up because there's a 7 here. I can see that. But that's not true. Because that means that if the score were 0-0 with 30 seconds on the clock, that scoring 7 points would have the same value. They're not the same sevens.
That's a great perspective.
They're the same number, but they don't have the same value. Now, answer the question, why don't they have the same value? Because it revealed more information.
See,
It
with the 30
revealed a
seconds
lot
left, the other guy's not going to be able to score.
Probably.
Probably.
And that's when the crowd, you might see the crowd get up and leave, even though there's time on the clock. And that's the equivalent of your option showing 0 bid. And you're going, hey, I've got 3 days left. How come there's no bid?
Or I
Because
have
the
a month
audience
left.
has said, this is basically over.
Or have a month left and they're a nickel bid and you get,
Same
should I
thing.
sell my option? I'm down 95%. Should I, really?
Right. So now let's take a look at this. Let's answer our question with this perspective.
You paid for information to be revealed, and it was revealed, and now you're pissed off that you paid for it?
That's the way Stu and I look at this when we do our services. We're paying for information. Just because we don't get the outcome we would have liked doesn't mean we didn't learn from it. We still, and now what we're going to do is to use the information. What do most people do? I blew it. Let's move on to something else.
Mm-hmm.
No, use that information. Use it. It's still valuable.
Yeah, the stock's not 160 anymore. The stock's 100. Maybe it's a little better opportunity at this point than it was when it was 160.
Now, and you're walking away from it because it went down.
Or maybe not. Right? There's no real answer to that. It's like maybe it's 100 because it was 160 and now it's 100 because there's a really solid reason, which might be the company is not really doing very well. That might be the case as well.
But right? You didn't know that. You didn't know that 6 months ago.
That's the point. You didn't know that going in.
Ago.
Right.
And now you do.
You kind of saved yourself 60 points on the stock, and maybe you blew 15 or 10 or whatever on the option, but you saved yourself a boatload of money. You're way ahead of the game.
Yep. So let's take a look at out of the money vertical spread. Stocks at 100, 105, 110 vertical. Again, this is a call vertical. I should have said that, but it's $1. And traders think that they're getting a great risk reward profile. This is kind of one of the most common reasons that we hear, oh, this is a better spread because I have
$1 to make 4.
$1 to make 4.
I'm in.
Anytime I can get that, I call that a great deal.
Great trade.
Absolutely the worst way to think about it. But now the question is, why is it relatively cheap?
It is a way to think about it, but it's a horrendous way to look at it.
It's going to get you hurt.
You're completely taking away the whole probability thing, and what are you getting rid of, and what are you selling off, and what do you get? You're not thinking about any of that. All you're saying is it's $1. Well, what does that mean? And are you paying $1 for something that should be a quarter? Are you paying $1? Is it overvalued? I mean, what is it that you're
dollar tells you nothing.
Selling?
That's an output. As Stu says, which I love this, he'll say that people go price shopping. They'll say, well, I'm controlling 100 shares of stock for $1. If I bought this other spread for $3.50 or $3, it's 3 times as much. So this is a better deal.
This is a better deal, yeah.
No. It's, again, you're thinking with your eyes. So let's take a look at why, now that we understand about options reveal information. And before we do that, quick little ad for us here, marketrebellion.com/get started right there on your screen. More information just like this. Speaking of information, we have lots of videos and articles to help you get started. Trust me when I tell you this game, the options game, investing game, is won not by red light, green light, but by having knowledge. And you want to make sure you get a firm foundation. So let's go back to our cup game. I'm going to make it a little bit smaller this time. And think of these as stock prices. All right, notice I didn't put stock prices on the last one, they were just cups. But it's the same idea. We're trying to just expand this model. Now we know that there's value in here somewhere. All right. So let's think that the stock could be somewhere in here. So based on this, Stu, where is the stock most likely, or which spread, if we had to buy a cup and sell a cup, let's say, is going to get the most information? Where's the stock most likely to be?
Well, right in the middle.
That would be a statistical guess. So which spread is going to capture that for sure?
Well, it would either be the 9,500 or the 100-105.
Well, but that's still not for sure. It could drift down into there, which go to the extreme.
75-125.
Well, okay, that's a different point. We're going to bring that up in the class. But for right now, the 75-80 would capture that for sure. Because if the stock happens to be 85, we still get $5. If it's up here at 100, we get $5. Stock's up here, we get $5. In other words, this spread is highly likely to contain $5 of value. And what does that mean that we're going to pay for that spread?
Well,
Very close.
pretty close to $5.
Very close to $5. Right. And that's because the market is saying what we call the mass or of your bell curve is most likely under here somewhere. These guys are pretty good candidates. In other words, the branches or the cups to the left don't have much value. Now, what if we do this? What about the 115, 120? Well, here's what's happening. In order for this to pay off $5, the stock would have to be either here at 120 or at 125. Statistically, that's a bad bet. If these are all possibilities before, like Stu said, this is going to be a better guess in this area, you're really pruning off all of these branches. That's the way to see it. Buying the out of the money call spread is cheap because you sold the corresponding put spread. So think about this. If we looked at the 115, 120 put spread, I bought the 120 and sold the 115. That is now controlling all prices to the left for the same reason, just in the opposite direction. And if that's trading for 4, the crowd is saying, like we just talked about over here, the crowd is saying that the value is probably in one of these cups. And because of that, I'm willing to pay 4 for it. And what you're saying mathematically is, I want to sell these branches. We know it's worth 5 if it's up here. That's the best reward you can get, but we're going to subtract off these branches. That's why you're paying 1.
That's the sale of the put spread. What Bill's talking about here is the topic is called synthetics.
Yep.
It's another way, it's a different way to kind of look at the position to see what it is that you have. It really is it is very revealing. I'll use that word since we're using it here.
No pun
It really reveals a lot. To be able to kind of look at this and say, well, I'm paying 1. Well, wait a minute. Am I really paying 1? Am I really selling the put spread at 4? That really gives you a whole new perspective on what it is that you're doing.
What you're saying
It takes away the whole, well, it's a debit, it's a credit thing. I want to sell credit. I want to sell put spreads because they're credits, and all of that just goes away.
Those are dollars. Options don't live in dollar space. They don't know.
Right.
They live in probability space, information space. So now there's one way we can show it, and I think we're going to do it today in Q&A. But we can do put call parity, which a lot of people don't know. We see it as a single strike, right? Stock plus put minus call equals a bond. But we can do it for multiple strikes. There's multiple put call parity equations. And if we do it for a vertical spread, we will see that it comes up to $5. That's the bond portion minus the put spread. That's exactly what put call parity shows. Now, here's another way that I think might be easier. If we buy the 105 call and sell the 110, that's a debit spread. If we buy the 110 put, long the 110 and short the 105, that's a debit spread on the put side. And collectively, that is called a box spread. We have boxed in, we have the right to sell at 110, and I have the right to buy at 105. I have boxed in, I've got it in the corner. It's got to be worth 5, no matter where the stock is. Anywhere
Yeah.
below 105, anywhere between 105 and 110, and anywhere above 110, it is worth 5 at expiration. So
So
that's another way.
go back. If you're getting lost there, everyone, just go back to basics. Go back to 101, right? This is your rights and obligations. So if you own that put, and it doesn't matter what the strike is, just assuming that they're both the same. If you own that put, you own the right to sell it. And if you're short the call, you have an obligation to sell it. One of those things will come true. But taking away the whole pin
Either way,
idea
you're
that
getting 110. Right.
either way, it's going to be 110. Either way, whatever happens, it's going to be 110. So it becomes what's known as a synthetic sale.
Yep.
And on the other side, it's the exact same discussion, except it's a synthetic buy.
Yeah. So if the stock is up here at 110, fine, we'll let the put expire worthless, but we'll sell at 110. If the stock is down here below 105, let's say even down at 0, fine, we'll exercise the put and get 110. We can always get 110. So this is just an easier way to show that this has to be worth 5 for these two spreads. This is an easy way to show the bond portion of put call parity. So there's your 5. Now, here's our put spread. And if we sell that, if that happens to be trading for 4 because there's more information in that direction, what do we do? You know what? I don't want this piece, and I'm going to get it as a credit, and that's why your call spread is 1. It's not because you've got a great risk reward profile. It's not because whatever all these different reasons that people say. It's because you're going for the area under the curve where there's a very low probability. And this is a beautiful way to show it. You have sold off this part of those cups.
Somebody just yesterday asked me for a quick and easy formula to determine if a risk reward scenario was worth it.
It's the wrong way to go about it.
Right, 100% exactly the wrong way. You have to work in the pricing and the probability of it. Why is it $1? Because
if they're in fact, that's a good question. If they're all priced fairly according to a pricing model, they're all great. They're all the same. They're just different levels, but they're all equally valid.
At that price,
that's not going to answer anything.
At that price,
At
right?
that price, yeah. Not going to answer anything. It's the same thing as saying on roulette, should I take a single number bet which pays off 35, or should I do a red-black bet that pays off $1? They're the same. They're just scaled differently. They're just different probabilities, but they both have in that case, an edge against you. But they're both the same. They're just scale differences. So back to our vertical spread, when we had our cups, and we're looking at this spread, we want to be long the 115. That's why it's green. We're short the 120. What are we really saying? First of all, statistically, where is the money most likely going to be? To the left of the green. And what you're saying when you buy that spread, nope, the value is not here.
See, why can Bill say that? Because there's, I don't know how many you got up here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. You got 11 cups up there. And where is it most likely not to be? Well, it has to be the majority, right? Down there.
No, it's most likely to be here, but you're selling it off.
Oh, yeah. I said that backwards. Yeah.
You are saying, as the trader, if you buy this spread, you're saying, I disagree with the crowd. It is definitely not here. And because I'm so confident in that, I'm willing to sell off these cups.
And you are absolutely free to do that. Just understand what it is that you're doing.
But see, that's what makes you do better decisions
for the payout. That's it.
That's what's making you do a better decision, is that you're not doing it because, it's only $1 and I'm controlling shares for $1.
And look, truth be told, it might pay off, and it might pay off big. And you might say, well, I put $100 in and I got 500 back. Wow, that's really good, and it is really good. It's just that we're trying to point out to you that you had a low chance of making it. Low doesn't mean 0.
Right.
Low
but
means
it also doesn't
low.
mean you're a super trader either, because you made 4 times your money.
It means, you know what it means in English, Bill? It means you got lucky.
You took a low probability.
And there's nothing wrong with that either.
Nothing wrong with that, right?
Except luck doesn't last forever.
There you go. You have to be very honest about that and say, that's the big statistical test. Can you repeat it? That's a whole nother discussion.
Can you repeat it? Can you put this equation into the mass part of the portfolio? Do you want to take your $1 million or 500,000 or $100,000 portfolio and bet for improbable outcomes time and time and time again over time, over a long
Math,
period, over decades.
right.
It's not going to work.
The math tells you it's not going to work.
It's not going to work,
No.
right? You have to bet for the probable outcomes. It doesn't mean you can't bet for the improbable outcome every now and then and have a little fun with it. But the expected value of that improbable outcome really at the end of the day is zero.
It's going to go down.
Yeah.
So back to our question. Stock is 100, 105, 110 vertical call spread for $1. Why is it relatively cheap, everyone? What do you say if you want to sound like a professional trader? A, it's because I'm controlling shares for $1. B, I have a great risk reward ratio. C, I can make a really good percentage return.
Yeah, I like that one. That sounds fun.
What's the answer, everyone? You sold the 105,
spread.
110 put spread. Why is that important? Because you're saying where it is most likely going to be statistically, I don't think is true.
Yeah.
That's going to help you make a better decision.
Yeah.
So that's all we have. Anyway, it's going to be a day and a half of this, Stu, and we're going to look at lots and lots of different things. Some of my favorite topics that I used to teach at FIU, and we're going to talk about Schelling points and Nash equilibriums, limit order book, liquidity vacuums, things that people have never heard of. So if you really want to take your options trading to the next level, please join us in Miami. And with that, I think that's a pretty good stopping point. I want to wish all of you again a very happy new year. Looking forward to it. This is going to be a theme for us going forward for Coach's Corner. And we'll look for you next week on Coach's Corner, and we'll see you then.
Yeah.